Hello, everyone, and welcome to episode 41 of JustDario Cigar Time. Last week, we finally received NVIDIA's results, and as expected, they were carefully crafted to avoid unsettling the markets, preserve the fragile AI narrative, and ensure that attention remains focused on the main event this September, the Federal Reserve decision at the upcoming FOMC meeting on whether or not to cut rates. This decision is pivotal, as it could determine the trajectory of the markets for the foreseeable future. Today, we'll dive into the implication of this decision, the shaky AI narrative, and the broader economic landscape. Before we get there, allow me to comment on recent developments in the AI space, particularly around NVIDIA and other key players. Last week, I published an article commenting on NVIDIA's latest result, and the picture is clear. The revenues are not materializing structurally or consistently as they should. The degree of accounting maneuvers employed by NVIDIA and other companies in the AI sector to project an image of robust growth has reached a point where it is questionable how they'll keep the momentum going in the next quarters. The narrative that, hey, everything is awesome, is shaking considerably. Investors and analysts are growing wary of accepting corporate claims at face value and are now scrutinizing the numbers more closely. This shift in sentiment is evident in the news trickling through mainstream media. Over the weekend, one story stood out. Scale AI, a company acquired by Meta for $14.3 billion, is turning out to be a rather ill-guided investment. This wasn't a straightforward acquisition. Meta effectively bought out Scale AI's key employees and technology in a way that avoided triggering antitrust concerns or scrutiny from the FTSE. Specifically, Meta structured the deal to acquire 49% non-voting stake in Scale AI, valued at $29 billion, allowing the company to remain independent on paper while securing access to its data labeling capabilities and hiring its CEO, Alexander Wang, to lead a new AI superintelligence lab at Meta. This structure mirrors other big tech deals, such as Microsoft's investment in Inflection AI and Google's arrangement with Character.ai, designed to sidestep regulatory hurdles by avoiding full acquisitions. The purpose of Meta's investment was to bolster its AI capabilities, particularly in data quality for training large language models, as Meta has struggled to keep pace with competitors like OpenAI, Google, and Anthropic. By bringing Wang and his team, Meta aimed to address its lagging model performance, exemplified by the lukewarm reception of its Llama 4 models, which underperformed in coding tasks and generated generic responses. What's more concerning is that Meta is classifying this expenditure as capital expenditure when it's essentially employee compensation. How auditors are signing off on this is anyone's guess, but it's a trend across the AI sector. Companies are dressing up operational costs as capex to inflate their financial health, similarly to what telecom companies did in the early 2000s. As I previously described in my article, how big tech spending spree more and more resembles 2000s telecom's epic fail. The fallout from this acquisition is telling. Reports indicate that Scale AI's technology is underperforming, with Meta's own super lab, built post-acquisition, resorting to competitor tools to develop its tech stack. Researchers at Meta's TBD labs have complained that Scale AI's data is low quality, prompting the use of competitors like Surge and Merkle to train next-generation AI models. Objectively, this should prompt an immediate impairment of Meta's investment in Scale AI, and investors should price this into Meta stock. However, with markets closed for the long weekend, we'll have to wait until Tuesday's opening to gauge the reaction. Personally, I suspect this news will largely be ignored for two reasons. First, it's being overshadowed by other events, such as social unrest in the UK and elsewhere. Second, investors struggle to quantify the true value and monetization potential of these massive capex investments, which companies have not been transparent about. Moreover, the rapid departure of a Scale AI executive brought on to run Meta's superintelligence lab after just 2 months signals internal challenges and further undermines confidence in the deal's success. These large capex investments from big tech companies, now ongoing for more than 2 years, have been staggering, yet the returns remain elusive. Companies like Meta, Nvidia, and others are pouring billions into AI infrastructure, but the promised trillion-dollar revenues and efficiencies are nowhere in sight. The lack of clarity and the sheer scale of spending are pushing these companies closer to a breaking point, where they can no longer sustain dumping cash into ventures with questionable viability. The Scale AI deal, intended to give Meta a competitive edge, instead highlights the risks of overpaying for unproven technology and talent in a crowded and overhyped AI market. As venture capital dries up, AI companies are turning to debt to keep the bubble inflated. Meta, for instance, is reportedly seeking to raise debt to fund new data centers, a move that underscores the desperation to maintain growth momentum. Similarly, CoreWave, a notable cash-burning company, has raised over $10 billion in debt on top of prior capital raises to build data centers, which it rents out below cost. This unsustainable model is fueled by the hope that client contracts, often with financially shaky companies like OpenAI, will justify further borrowing. OpenAI, for example, is projected to burn up to $20 billion by 2027, an astronomical figure that highlights the precariousness of the AI sector's financial structure. These companies are betting on a massive amount of future revenues that might never materialize as such, and their reliance on raising debt shows how they are quickly running towards a brick wall. Lenders, however, are hesitant to finance ventures that lack long-term business viability, especially when the potential returns are dwarfed by the risks. CoreWave's strategy of raising debt against client contracts is particularly concerning, as these clients often lack strong cash reserves themselves. This debt-fueled approach is a symptom of a broader issue. The AI sector has overbuilt data centers and overhyped product applications, yet monetization remains limited. Companies that have attempted to generate revenue from AI have seen modest results, often limited to cost savings rather than transformative income streams. The gap between the promises of AI and its actual performance is widening, and investors are beginning to notice. Narrative that AI will deliver trillion-dollar efficiencies is increasingly difficult to sustain, and the cracks in this story are becoming impossible to ignore. AI bubble isn't just about unsustainable spending. It's also propped up by questionable accounting practices. Take Supermicrocomputer, for instance. In its latest 10-K filing, SMCI admitted it hasn't resolved the accounting issues we discussed many months ago, which led to the resignation of its auditor, Ernst & Young, followed by the conditional appointment of BDO as a new auditor. This new auditor appears to have signed off on W's accounting to keep SMCI listed on NASDAQ, preventing the company's implosion from derailing the broader AI narrative. Remarkably, the stock exchanges allowed SMCI to remain listed despite not meeting all requirements, effectively turning a blind eye to protect the market's momentum. This decision prioritized trading volumes and IPO prospects over integrity, and as a collapse in SMCI could trigger lawsuits and damage the exchange reputation. Such leniency highlights a troubling level of business dishonesty. Some might even call it fraud or corruption that permeates the sector. Nvidia, at the core of its narrative, benefits from this complacency, as its stock price and market dominance depend on the perception of unstoppable AI growth. However, this house of cards is trembling. The Fed's upcoming decision in September will be critical in determining whether this bubble can be propped up for a few more quarters. Traders are currently pricing in an 85% probability of rate cut, a move that would be irrational under normal market conditions. Stocks are at all-time highs. M2 money supply is rising. Inflation remains sticky and house prices are near record levels. Government deficits are spiraling and financial conditions are excessively loose. By the Fed's own mandate, as discussed in my previous podcast, Unmasking Powell's Jackson Hole warning and preparing for an immediate moment of truth, analyzing Jerome Powell's Jackson Hole speech, the labor market doesn't justify a rate cut, and inflation risks argue for tighter policy, not looser. So why is a rate cut even on the table? The answer lies in the Fed's unspoken mandate, maintaining global financial markets stability. Since Alan Greenspan's era, the Fed has prioritized propping up markets over strict adherence to its dual mandate of full employment and price stability. A rate cut, likely 25 basis points, though a 50 basis point cut would have a stronger effect, will delay the inevitable correction in stock prices, particularly in the overhyped AI and tech sectors. However, even a significant cut might not be enough to sustain the bubble indefinitely. If the Fed cuts rates aggressively, it risks sending the wrong signal to markets, potentially exacerbating inflation and undermining confidence in government debt. Real interest rates are already negative, and further cuts would reduce the incentive to hold bonds, which are essentially future fiat currency. Long-term yields are rising, creating balance sheet holes for financial institutions, a problem that can be masked only as long as liquidity remains abundant. However, speculative and inefficient AI and stocks investments are draining liquidity, setting the stage for a potential crisis with even margin debt on stocks now at new all-time highs. The Fed faces a stark choice: prop up markets at the cost of economic stability or allow a correction that could trigger a stampede out of stocks, reminiscent of 1929 but potentially worse. The initial impact will hit overvalued tech and AI stocks, followed by banks, financial firms, and real estate. Credit markets, already showing signs of stress with rising delinquencies in commercial real estate, consumer lending, and beyond, could seize up if debt investors panic. The bond market, 10 times larger than the stock market, could amplify the fallout in a high inflation environment. So what can an investor do? The Fed may delay the bubble's burst for a couple of quarters, but the fundamentals suggest a crash is inevitable. Central banks are losing their grip on markets, with long-term yields behaving independently of short-term rate controls. Social unrest in countries like UK, France, and even Japan reflects growing public frustration with economic conditions, undermining the narrative that rising stock markets signal broad prosperity. People are questioning who truly benefits from this bubble, and the answer, only a small elite, fuels discontent. To navigate this environment, I recommend building up bedrock of hard, scarce assets like gold and silver. These assets preserve purchasing power in the face of fiat currency debasement, which is accelerating as governments and central banks resort to reckless policies. Stocks with their inflated valuations are a poor edge against inflation, as a correction could wipe out gains. Long-term bonds are equally risky, offering negative real yields and facing potential bailouts in G7 countries like the UK and France. The best strategy is to maintain dry powder, cash, and TBS reserves as well to capitalize on the opportunities that will emerge post-crash. When valuation returns to earth, after a long and painful cleansing process that will begin to unfold in Q1 next year, the stage will be set for a new economic cycle. This cycle, potentially led by China rather than US, would be one of the longest and most robust in history, driven by liquidity re-entering risk assets from the bottom. Historical parallels, like the recoveries from the great financial crisis of the 1930s, suggest that those positioned at the bottom will reap significant rewards. In conclusion, a Fed rate cut might buy time, but it won't prevent the bubble's collapse. Investors must prepare for turbulence, protect their wealth with scarce assets, and be ready to act when the market resets. The next few quarters will be pivotal, and those who plan ahead will be best positioned for what comes next. Thanks a lot for listening to my episode again today, for liking the video, for subscribing to my YouTube channel. I would like to remind you the special offer that we have at Synax till the 30th of September to access 1 month free unparalleled stock market intelligence and then lock in a 1-year subscription for just $15. Thanks a lot for supporting me on X, for following me on Instagram, and for reading and commenting my articles on JustDario.com.